Hello, and thank you all for joining. Today we have a very interesting webinar, and if you've joined, you've probably been thinking a little bit about your Social Security benefit, so just know you're in the right place. My name is Luke Yango, and before we begin, let me give you an overview of our firm. And I always like to mention, though, that any tax-related items that we'll be discussing generally are best to be reviewed with your CPA, so just keep that in mind as we discuss some tax-related items today. But we're a boutique wealth management and financial planning firm here in Irvine, California. However, we do have clients across the entire nation. And what we do with our clients, many of which are on the line, is we work with them on their holistic financial planning and investment management needs. I personally found that our industry is too focused on just the investment side of planning, stocks, bonds, mutual funds. So we've made it a priority to take both a comprehensive and a holistic approach to planning that we do with our clients. And we continuously educate, which is one of the reasons why we host this webinar series. Now, our process involves building out a well-designed financial plan, organizing our clients' investments in coordination with their plan, and then ensuring that any outside planning items have been handled, which may or may not involve our collaboration with outside professionals like attorneys or CPAs. And here's a quick overview of our team. And within the firm, we have 7 planners, myself included, a retirement plan specialist, an investment specialist, and then 3 administrative assistants. But enough about us, let's dig into today's information. And the point of this webinar series that we're hosting is really to dive deeper into some of the areas of planning shown here on the planning pyramid. And Social Security is a key aspect to everyone's retirement plan. And it's a very, very large benefit, even if it doesn't appear to be so on that Social Security statement that you get once a year. So in planning for retirement, it's imperative to plan for Social Security. So for today's conversation, we're going to dive into the 6 most important rules, in our opinion, to be aware of when claiming your benefit. And let's just jump right into it with rule number 1. So the first and the most important thing to understand is that monthly benefits will rise with claiming age. In other words, the longer that you wait to file Social Security, the higher your benefit is going to be. But to illustrate this, we do need to cover a little background. We'll first start off with some definitions. The primary insurance amount, or PIA, is your base monthly benefit. And now, it's going to be calculated at age 62 based off your highest 35 years of earnings. It's basically the amount that you'll receive if you file for Social Security at your full retirement age, which I'll talk about next. PIA is based off of your earnings history. So if you've earned the Social Security maximum every year for 35 years, you qualify for the maximum PIA, which is $3,627 for those turning 62 in 2023. If you've worked less than 35 years, or if you have some lower earning income years, you may still have the opportunity to increase your Social Security benefit by working longer and earning more. But our focus here is claiming age, so let's just keep going. Another definition that we need to understand is full retirement age. This is not necessarily the age that you plan to retire. Rather, it's the age which you would claim full unreduced Social Security benefits. For everyone born between 1943 and 1954, full retirement age is 66. For everyone born in 1960 or later, full retirement age is 67. For those born between 1955 and 1959, full retirement age is going to be 66 plus some number of months. And as I've already mentioned, full retirement age is the age that you can claim your Social Security benefit. Claiming Social Security before your full retirement age will cause your benefit to be reduced. On the other hand, claiming Social Security after your full retirement age will cause your benefit to be higher than your PIA because you are earning delayed retirement credits. The timing of when you claim is incredibly important because the age you file determines your permanent monthly benefit. If you live longer than average, or if even there's a chance that you might live longer than average, often you'll be better off filing later and collecting a higher benefit for life, even if that means waiting a few more years for your checks to start. So let's talk a little bit more about this. Now remember that I said that your PIA is the benefit that you will receive at full retirement age. So what happens if you apply for Social Security before full retirement age? Well, your benefit is going to be reduced. So if your full retirement age is 66 and then you apply at 62, you'll receive 75% of your PIA. At 63, it's 80%, and so on. If your full retirement age is 67 and you apply at 62, you'll then receive 70% of your PIA. Now, these amounts are actually prorated monthly, so you can really apply anytime after age 62, and your benefit is going to be reduced by the proper amount. Now, if you apply for Social Security after full retirement age, you'll earn delayed credits of 8% per year for each year that you delay. So if your retirement age is 66 and you apply at 67, now your benefit's going to be 108% of your PIA. At 68, it'll be 116, and so on. But after age 70, you cannot earn any more delayed credits, so it does not pay for you to wait until after age 70 to apply for Social Security. You're essentially just going to be leaving money on the table if you wait past 70. Now, I mentioned that the age that you claim Social Security dictates your permanent monthly benefit. However, in any year there's inflation, your benefit's going to get a cost of living adjustment, or COLA for short. Now, this year's cost of living adjustment was 8.7%, but historically, COLAs have varied widely. Now, the COLA is applied to the benefit amount as a percentage. So the higher the benefit, the higher the COLA is going to be per dollar, or as a dollar amount, excuse me. And it applies to benefits that you haven't claimed yet as well. So once your PIA is calculated at age 62, it's going to rise each year with the cost of living adjustments as well, even if you delay claiming to age 70. So to summarize, the upshot is that between delayed credits and cost of living adjustments, the advantage to delayed claiming is greater than most people actually realize. And to close out this rule, the when to apply question becomes very complex. Just know that if you apply early, your benefit starts out at some fraction of your PIA and remains at that percentage for the rest of your life. It doesn't go up to 100% when you reach full retirement age. This is a huge misconception. COLAs magnify the impact of early or delayed claiming because the annual cost of living adjustment is applied to either the lower or the higher amount. This causes the difference to increase every year that goes by. The when to apply question impacts survivor benefits as well. The higher earning spouse maximizes his or her benefit by delaying to age 70. And this higher benefit will transfer over to the lower earning spouse at death. We'll cover this a little bit more when we get into spousal benefits. And of course, you'll need to take into account your health status, life expectancy, income needs, and overall retirement plan when deciding when to claim Social Security. This is when having a conversation with your current advisor or someone like myself will be invaluable. So with that, let's go on to step number 2, or rule number 2, which is your spouse may be able to get a benefit based off of your earnings record. And here are the rules for spousal benefits. The spousal benefit equals 50% of the primary worker's PIA if the spouse applied for it at full retirement age. The primary worker must have filed for their benefits. So in order for, let's say, Jill to claim a spousal benefit based off of Jack's work record, Jack must have filed for his own Social Security benefit. This rule comes into play when we talk about claiming strategies as well, and it can trip you up if you are not careful. Next, a spouse must be at least age 62 to file for a spousal benefit. And if the spouse claims at 62, that benefit is going to be reduced. We'll see this in a moment. Spousal benefits do not earn delayed credits after full retirement age. So the most a spouse can ever get is 50% of the higher earning spouse's PIA. This is extremely important to know. It doesn't necessarily wait to or benefit to wait to 70. And finally, for the most part, you can only get a spousal benefit if it is greater than the benefit available on your own record. That is, if 50% of your spouse's PIA is higher than your own PIA. And as I mentioned, the spousal benefit is 50% of the higher worker's PIA if he or she applies for it at her full retirement age. So if Jack's PIA is 2,000 and Jill's PIA is 800, and if Jill applies for Social Security at her full retirement age, her benefit is going to be equal to $1,000. This is 200 more than her benefit based off of her own work record. Now, what if the lower earning spouse's PIA is more than half of the higher earning spouse's PIA? Well, in this case, he or she may not receive a spousal benefit. They're just going to be paid on their own record instead. And regardless of which rules you fall under, the key to maximizing benefits for a married couple is to coordinate the two benefits. And here's what we found. When both spouses have relatively high PIAs, that is, the lower earning spouse's PIA is more than half of the higher earning spouses, it pays for both spouses to claim the respective benefits at age 70 to get the maximum delayed credits. And that is, of course, if you expect an average to a long life expectancy. Our calculations show that if both spouses have this average or longer than average life expectancy, then this will maximize their benefits for both of them over their lifetimes. Now, let me show you an example. Let's say Bob and Betty are married. They're both age 59 now. Betty's PIA is 2,600, Bob's PIA is 2,600. Betty's PIA is 1,800. And let's assume life expectancies of 85 for Bob and 95 for Betty. When do you think they should claim Social Security? Well, our analysis identifies several claiming scenarios for Bob and Betty. Scenario 1, they both claim as soon as possible at age 62. Scenario 2, they each claim at full retirement age, which is 67 for both of them. In scenario 3, Betty claims early at 62 and Bob claims later at 70. Scenario 4 is the maximum benefit based off of life expectancies of 85 for Bob, 95 for Betty. And this scenario calls for both of them to claim at age 70. And to illustrate this, here's a graph showing the lifetime benefits for each claiming scenario. It's hard to see on the left, but did you ever think that a couple could receive over $2 million in Social Security benefits over their lifetime? That is exactly what can happen if you resist the urge to claim benefits at age 62. And you can clearly see here, they get the most lifetime benefits if they each claim at 70. But if Bob dies, Betty will then be entitled to a survivor benefit, and this chart shows the first year survivor benefit for the longer lived spouse, in this case, Betty. So when Bob dies at age 85, she then actually steps into his benefit as the survivor. And you can see here that the two scenarios that call for Bob to claim his benefit at 70 will ultimately give Betty the highest survivor benefit. Now, what if we change Betty's PIA to $800? This is less than half of Bob's PIA, so she should be entitled to a spousal benefit. Again, the analysis shows the amounts they would receive if they each claim early at 62 or at full retirement age. Scenario 3 shows Betty's claiming early and Bob claiming later. The maximum lifetime benefit, scenario 4, has Betty claiming her benefit at full retirement age and Bob claiming at 70. The nuance to this strategy, though, is that at age 70 for Betty, she'll then claim based off of Bob's record. So she'll get a spousal add-on to her benefit as well, making it a larger benefit. This is how coordinating benefits can pull more money out of the system and put more money in your pocket. Now, this graph does look similar to the first example, but the total amounts are a little lower now because Betty's PIA is lower in this case. But you can see at a glance which claiming scenario provides the most lifetime benefits. You can also see how close they are. For example, scenario 3, where Betty claims her benefit at age 62, is very, very close to scenario 4, where she waits just 5 more years and claims at full retirement age. So she might want to go ahead and start her benefit at age 62. The important thing is for the higher earning spouse to claim at age 70, because that maximizes the higher benefit for Bob while he is alive and for Betty after he dies. Total benefits, however, will depend on life expectancy assumptions, and for these examples, like I mentioned earlier, we used 85 and 95. 85 for Bob, 95 for Betty, but they can always be changed. But enough about the calculations. Let's discuss divorcee benefits. And this is another basic rule. A divorced person may be able to get a spousal benefit based off of an ex-spouse's work record. The rules for divorcees are very similar to ones for married couples, but there are a few additional restrictions. First, a person can receive Social Security based on an ex-spouse's work record, providing that the marriage lasted at least 10 years and the divorced person claiming the benefit is currently unmarried. These are the two key rules. It doesn't matter when the marriage and divorce took place. If the marriage lasted for at least 10 years, even if the divorce happened a very long time ago, a divorced person may be able to claim a Social Security benefit off that ex-spouse's work record. The person claiming the benefit must be currently unmarried, and you could have 2 or 3 marriages after the first one, but as long as those marriages ended and you're currently unmarried, you can claim a divorced spouse benefit. If you have more than one ex-spouse in your past, and if your marriage has lasted 10 years or more, you can actually choose which spouse's record to claim a benefit on. The order of the marriages and divorces really doesn't matter. Other rules are that the ex-spouse must be at least age 62, and if the divorce occurred more than 2 years ago, the ex-spouse doesn't need to have filed for his or her own benefits. Now, there are a few more things to know about divorced spouse benefits. First, the benefits paid to one ex-spouse does not affect that paid to the worker, the current spouse, or the other ex-spouses. You don't need to know your spouse's or your ex-spouse's whereabouts, only enough information that the Social Security Department can look up his or her records. You'll also need to provide documentation showing the dates of the marriage and the dates of the divorce. And if you're receiving divorce spouse benefits and you remarry, your benefits will stop. However, you may then be eligible for a spousal benefit based on your new spouse's work record, or you can just switch to your own benefit if you also qualify for Social Security. So that covers divorce. Once again, a little complicated here, but these are all very important things to be aware of. Let's move on to the next rule, which is survivor benefits. Now, this is where things start to get a little less basic, and we'll try not to get too lost in the weeds today. But survivor planning is essential, and there are a few things that you should absolutely know. First, let's discuss who can get a survivor benefit. In order for you to receive a survivor benefit, the marriage must have lasted at least 9 months, except in the case of an accidental death. To start benefits, the survivor must be at least age 60 or 50 if disabled. However, if the widow or widower applies before full retirement age, those benefits will be reduced as it is for regular retirement benefits. If you remarry before the age of 60, you won't be able to receive a survivor benefit based on your previous spouse's earning record unless your remarriage ends. We've actually seen cases where someone's contemplating marriage or remarriage in their late 50s. In those cases, we often recommend a long engagement so you don't lose your survivor benefits from the first spouse. If you remarry after age 60, though, you still keep those benefits. Additionally, divorced spouse survivor benefits are there if the marriage lasted over 10 years. And remember that survivor benefits are worth twice as much as spousal benefits, 100% of the worker's PIA instead of 50%. Now, if both spouses are receiving benefits and one spouse dies, the other spouse can switch to the higher benefit. They're not going to keep both, but they will inherit potentially their spouse's benefit if it is larger. Here's a hypothetical example. Let's say Joe and Julie are both married. Both are over full retirement age and currently receiving Social Security. Julie's benefit is $2,000. Joe's benefit is $1,200. And if Julie dies, Joe's $1,200 benefit will stop, and he'll start receiving $2,000 monthly. And please note that if Julie had maximized her benefit by filing at age 70, and say her benefit was $2,600 because of those delayed credits, Joe's survivor benefit would be $2,600 instead of $2,000. This just shows the importance of Social Security planning ahead of time. Now, without going into too much detail here, the main point I want to get across is that the amount of the survivor benefit will depend on two things: the age that the deceased spouse originally claimed his or her benefit. This determines the original benefit, and the age that the widow or widower claims the survivor benefit to determine the actual benefit. The widow or the widower will receive the highest income if the deceased spouse originally claimed his or her benefit at age 70, and the survivor claims the survivor benefit at full retirement age or later. Higher earning spouses who feel young and healthy usually don't think about the survivor benefit when they're deciding to claim their own benefit. But as we saw with the examples of Bob and Betty, Mike and Mary, the survivor income can be significantly lower if the higher earning spouse claims his or her benefit early. Survivor planning is a very important part of Social Security planning for married couples. It can influence the surviving spouses, or it can help to improve the surviving spouse's standard of living later on based on the decisions that you make now. Now, what if you have already been widowed? Let's say your spouse died either before or after starting your Social Security benefits. Or maybe you were married over 10 years, divorced, and your ex-spouse has died. Is there anything that you can do to coordinate your survivor benefits with your own retirement benefits to maximize your lifetime benefit that you receive? And the answer is yes. You can sequence your benefits to your advantage. You can start with one benefit and then switch to another. The rule here is always to take the higher benefit last though. So if your survivor benefits are higher, start with your retirement benefit at age 62 and then switch to the survivor benefit at full retirement age. If your retirement benefit is higher, start with the survivor benefit at as early as age 60 and then switch to your retirement benefit at age 70. I have a client who lost her husband years before full retirement age. When we were discussing when should she take her Social Security, I brought up the fact that she'll have a survivor benefit from her late husband. And she told me, well, he didn't make that much while he was working, so it probably isn't worth that much. Excuse me. I still encouraged her, though, to check with the Social Security office, and she actually found out that she had a pretty substantial benefit on his record, which ended up being tens of thousands of dollars of additional benefits. She was able to hold off on receiving her own benefit until she turned 70, giving her a higher benefit for the rest of her life. And needless to say, she was thrilled about finding this out because ultimately she pulled more out of the system. But that about sums up survivor benefits. And as you can see, it does get a little complex here. So let's move on to rule number 5, which is the reduction of benefits. And we've already talked about the disadvantages of early claiming in terms of that permanent reduction, but there is another problem, one that may make you think twice about claiming early. And if you claim before your full retirement age and you continue to work and make an income, a portion of your benefit may be withheld, and this is what's called the earnings test. So if you apply before you turn full retirement age and you earn more than $21,240 in 2023, $1 in benefits will be withheld for every $2 over that threshold. Now, it's important to know that the money isn't truly taken away. Rather, your benefit is just going to be adjusted when you turn full retirement age to make it as if you just applied later on. So this means that if some of your benefits are withheld due to the earnings test, your new benefit will be slightly higher in the future. And if you as if you started claiming at 63, 64, 65 instead of age 62. And this can actually be advantageous in the event that you filed at 62 and you regretted it. So if you've applied for your benefit, then please don't let the annual earnings test discourage you from working, though. The more money you earn, the more money you'll have, and Social Security doesn't necessarily penalize you for working. But to avoid the earnings test entirely, though, just wait until full retirement age or later to apply for benefits. And another thing about the earnings test is that it applies to every kind of benefit: retirement, spousal, and survivor. If John and Jane are 62 and Jane is getting a spousal benefit off of John's record and John goes back to work, then Jane's spousal benefit may be withheld. And the Social Security Administration is on to business owners who pay themselves a very small salary in order to get around the earnings test. So for business owners out there, you may be subject to extra scrutiny. Let me just say that the earnings test, it's a hassle. You can skip it entirely by just claiming Social Security after you turn full retirement age. And that brings us to our last rule, which is Social Security benefits may be subject to income tax. And the amount of tax you'll pay on the benefit depends on how much other income that you have. So this table shows the federal taxation of Social Security benefits on the various income levels. Income, in this case, it means provisional income, which includes adjusted gross income plus 1/2 of the Social Security benefit plus any tax-exempt interest. So if provisional income is under $32,000 for a married couple, no Social Security benefits are subject to tax. If provisional income is between $32,000 and $44,000, up to 50% of a married couple's benefits will be subject to tax. If provisional income is over $44,000, up to 85% of benefits are subject to tax. The thresholds for a single individual are $25,000 and $34,000. And in the case of married filing separately and living with the spouse, 85% of Social Security is taxable regardless of income. The important thing to remember here is that up to 85% of your Social Security benefits may be subject to federal tax, depending on how much other income you have. Additionally, states typically don't tax Social Security. For example, California, where I live, doesn't. However, there are 11 states, I believe, that do tax Social Security. Now, you can minimize taxes on Social Security by lowering other income, especially investment income. But you should be aware that municipal bond income, which is usually tax-free, does count as income for the purpose of calculating the tax on Social Security benefits. Now, if you've seen any of my past webinars, you know that I don't like taxes, so there are a few things that you can do to lower your tax bill. First, anticipate the required minimum distributions from your IRA, which may cause you to be in a higher tax bracket and may cause some of your Social Security benefits to be taxed. Second, consider drawing down IRAs before RMD age or to use Roth conversions early on in retirement to lower the amount of retirement funds in those pre-taxed investment accounts that ultimately will have RMDs assessed to them. And third, manage your taxable accounts in a tax-efficient manner to reduce capital gains, interest, and dividends. Or once again, just delay Social Security in order to reduce the number of years that your benefits are subject to tax. At the end of the day, there's only so many things that you can do to reduce your tax bill, but it is always best to be proactive rather than reactive. So that is why I always recommend making Social Security planning a key area in your overall retirement income plan. And while today's presentation did cover a lot, I'm sure that you all have questions, and we're here to help if that's you. Whether it's something small or large, don't be a stranger. We do these seminars to help to educate, but we're always happy to talk one-on-one, whether or not you're a client. So what we're going to do now is open it up to any questions that you may have. There's going to be an opportunity to raise your hand at the bottom of your screen, and then I'll be able to unmute everyone one by one for you to ask your question. But for those watching the pre-recorded webinar, I do need to close out ahead of the Q&A session. So if you have any questions, feel free to reach out to me directly. I'm happy to help. So thanks for joining, and I'll start with the Q&A shortly.